Live from Singapore, this is Inside with me, Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. The Trump risk forces the South Korean central bank to go off script, the BOK making a rate cut, going against its stance of refraining from back-to-back easing as it sees trade troubles brewing. With central banks and investors across the world bracing for the Trump impact, we speak with Templeton Global Investment CIO Manraj Sekhon to get his plan for navigating the risks. Also ahead, Australia is set to enact a law making it the first country in the world to ban social media access for children under 16 years old. We'll discuss this historic move with a former Facebook CEO for Australia and New Zealand, Scheeler. Well, Korea's central bank has surprised economists and investors with a successive cut to interest rates. It's seen as a preemptive strike on the economic headwinds and trade risks looming under the second Trump presidency. The BOK delivering a 25 basis point cut, taking the benchmark to 3%. Our own Avril Hong is here with the cause and effect. And of course, Avril, it is a preemptive strike, even if it is at the expense of the Korean won.
Yeah, we're already seeing that effect, right? The market implications and the slide of Korea's currency. And it's interesting how Lee Chang-yong has also highlighted they will work closely with the government to manage any FX volatility if it arises. But other asset classes also moving on the surprise cut. Take a look at bond futures, how they are really enjoying this move. The stock market is recovering some of the declines from earlier in the week. Note here, this was by no means an easy decision. That's something that Lee Chang-yong acknowledged himself, saying it was difficult. And also keep in mind how two members actually opposed the move. Of course, the successive cut was not expected because of what that might mean for financial stability. That was the subtext. Flip the board and take a look at what else we got out of South Korea today, because they cut the growth inflation forecast. And this is, to your point that you alluded to earlier, a preemptive move against Trump's economic agenda. We have housing market, inflationary pressures in South Korea. That's cooled a little bit. What is key for policymakers now, it seems, is shoring up growth in anticipation of what we might get from the Trump administration. Flip the board again. I wanted to put things into further perspective for you, because South Korea, as you know, is incredibly reliant on trade, and export growth has been slowing. And you look at its top trading partners, it exports about a fifth of its goods to China. And it also has a trade surplus with the US. Does that put a target on its backs as far as the Trump administration is concerned? Flip the board again, take a look at other Asia currencies, because in separate comments, the finance minister highlighted that, it is not just the won that is weakening. Indeed, if you look at the rest of Asia, this is how they fared in the past month. You really get the sense that all Asia central bank meetings are now live, and some might even follow suit with the BOK Has.
And for the Korean won, it is actually the worst performer in Asia year-to-date, down almost 8% versus the USD. Avril Hong, we thank you so much for that. Well, that surprise cut from the BOK is just the latest easing move by regional central banks this week. Let's get more analysis of the big picture with Manraj Sekhon, CIO of Templeton Global Investments, who is with me in the studio. Good to have you with us. BOK won't be the last to be cutting rates to manage to support growth.
Well, let's see, Haslinda. It was a surprise move. As we heard, GDP growth forecasts for next year have been brought down. You have to ask yourself why they are taking such a preemptive move. The Korean economy has been weak even in the last year. They've been trying to restructure some of the companies with a value up program to increase shareholder value, improve corporate governance. But there's a bigger picture here. And I do think the GDP growth forecasts are a reflection of the uncertainties that 2025 brings. We're not clear what President-elect Trump will do fully. There's obviously been a lot of talk, a lot of bluster, both before and post the election. And economies in Asia, policymakers in Asia are watching very closely.
And for Korea, even with a 25 basis point cut, is adding very little to growth, 0.07 percentage points. You got to wonder what more needs to be done. And of course, we heard from the governor himself that 3 out of the 6 members say that, you know what, another cut won't be surprising in the next few months.
Yeah, I think the signal is there that they are concerned. I think the markets are surprised that they've taken such a move. So the signal is that things are going to be tough for a while, and they need to improve consumption. But when you look at the sentiment in the region, when you look at the sentiment in Korea, I think that will be tough. So I don't think we're at the end of this phase. I think we're going to go through this phase for a bit longer in Korea.
So central bank governors are already reassessing. How are investors looking at it? I mean, are you reassessing your strategy? How are you re-looking perhaps 2025?
I think this phase we're in into 25 is probably one of the key periods where you really have to find a way of disaggregating the short-term noise, the short-term volatility, the policy risk, the headline risk, especially post a Trump presidency coming in Washington, with the long-term trends. And those are quite different. So talking about central banks, I think it starts with the Fed. We've seen the inflation numbers coming out of the U.S. We've seen the growth numbers coming out of the U.S. The economy is still fairly strong, notwithstanding inflation in some areas having come down a bit. So I wonder whether the Fed plan for rate cuts and what the markets have been expecting for a while is actually going to play out. I think if the Fed had seen the economic data over the last couple of months, if they had perfect foresight, I'm not sure we would have had 75 basis points of cuts already. So I think the market is going to recalibrate. So that I think is a question mark for the economy.
The thing is, the market has recalibrated. If you take a look at expectations for rate cuts next year, a lot has come off. We're looking at 75 basis point cuts for 2025. So I guess, in a way, the canary in the coal mine, as you've said before, is where yields are headed. What assumptions are you making?
I think 75 basis points is a question mark for next year. And as we were talking about a few minutes ago, post the U.S. election, equities have done well, the dollar's done well, but interestingly, bond yields have shot up. So bond yields, long bond yields in the U.S. are now higher than they were post the first rate cut, which is very unusual. So the market is factoring in the risk of the policy, the consequences of the policies that Trump bring it in, which will be potentially inflationary and potentially negative for growth in the U.S. So if you put that together, the risk of a more stagflationary picture for the U.S. is not insignificant, and we need to see how that plays out. In terms of what we're doing for portfolios, I think we have to take a very cautious view on the short term in places like China. I think there's an external set of challenges for China with respect to Trump and tariffs, which quite honestly nobody knows the answer to. I think we can speculate, but the risks are significant. But I think the bigger issue for China is what's happening domestically. They've introduced a lot of stimulus. There has been some recovery in the markets, but institutional investors have not fully bought into the stimulus. You've seen the retail investors come in. Domestic institutions and foreign institutions haven't really seen the clarity that the policymakers would like us to over the course of next year. So that's a big issue domestically before we start looking at what Trump policies mean for China.
Before I pick up on China and the rest of Asia, we spoke with Nurul Rabini, who says that given the circumstances that we're seeing right now, the picture that you've just painted, a 60-40 portfolio will underperform.
Yeah, well, I think Nuriel makes some very good points. I think the underlying picture for equities in terms of growth, in terms of reform, in terms of the structural drivers, that is unchanged. And I think we're going to see a good backdrop for equities. Notwithstanding what's happening with the Fed, we're still on a generally easier path for rates. With respect to bonds, I think that's a little bit trickier for the reasons we just talked about. If we do see Trump following through with his policies, if we do see inflation stay relatively strong, then I think you get a lot more volatility in bond yields. So the attraction of a 60-40 portfolio is you get the growth from equities, but you also get the reduced volatility from bonds. And if you're not getting the volatility that you expect from bonds, that's not attractive. But to be fair, investors who allocate to 60-40 portfolios normally take a 5-10 plus year perspective. So yes, it could be a bit volatile for 2025, but maybe for the longer term, that's going to be a little different.
But even if it's not 5-10 year perspective, it's definitely for a 4-year perspective, because that's how long his presidency will last. If it's not a 60-40 portfolio, what would the alternative be?
Yeah, well, coming back to his term, so he has, as we understand, a 2-year phase till the midterms. And a lot of what happens that he really is focused on will happen probably over the next 6 to 12 months. So I think we're going to have a fairly clear picture over the next 6 to 12 months on what the next 4 years looks like. And is it true follow through of all the tariffs and all the other threats or not? And that has huge implications for global trade, for the world economy, for China, whether we end up with true strategic global decoupling of the US system and the China system over time, or we find some form of resolution. I'm not sure we're going to see resolution anytime soon, so it would be a time to be cautious on the consequences of that.
Are we still looking at S&P exceptionalism?
I would say yes and no. I think what's happening in the US in terms of innovation, in terms of AI, in terms of structure of the economy, in terms of the capital markets, we're not seeing that anywhere else. If you look at the other major capital markets of the world, whether it's UK or Europe or Japan, they're struggling to varying degrees. So I don't think that changes. Having said that, I do think what we've seen since the middle of this year, which is a broadening out of the markets, will continue. So the so-called Magnificent Seven peaked roughly in the middle of the year. Since then, you've seen traditional value companies in the US and elsewhere do well. You've seen small caps, which has also been a huge laggard, do well, as people have priced in the top of the rate cycle and growth broadening. So I think you continue to see a fair degree of US exceptionalism, but you see a broadening out where markets that have lagged, whether it's traditional value, whether it's parts of Europe, I wouldn't say all of Europe, small caps around the world have lagged. All of those continue to do well. So I think it's more balanced than it was before.
You talked about how we're not seeing innovation elsewhere except in the US, but some might argue you see innovation in India, and that's the way to invest in the country. Of course, valuations are elevated. They remain elevated. People talk about the valuations in the US being high, but it's even higher in India. How might you play the Indian market?
Well, I think the innovation we're seeing in the US is very different. It's an AI leader. It's a leader in other very scale parts of the technology space, whether it's healthcare and biotech. So it's a very different kind of innovation you're playing in the US. And I think that continues. We're positive on the AI story longer term. And I think it's very difficult to reflect that elsewhere. India is the other end of the spectrum, where you have innovation for a very broad, large emerging economy where wages and incomes are much lower. So it's about providing access to people who don't have access to technology, to financial services, to goods and services. And you're seeing, as a result of that, a lot of disruption in the economy. So a lot of the traditional players are getting disrupted. I would say even the disruptors from a few years ago, they're getting disrupted. So there is innovation in terms of e-commerce, in terms of healthcare, in terms of financial services. You're seeing what we describe as the leapfrogging of the economic models. They're not following the traditional linear models of the developed markets. They're creating their own models to provide access to goods and services. So I wouldn't describe India as overly expensive. Like the US, I think if you look at the headlines, there are stocks that are richly valued. But if you look underneath that in certain parts of the market, like the banks, like some parts of the consumer area, actually stocks are reasonably valued. And India's a long-term story.
Also, when it comes to India, it is pretty much buffeted from Trump's tariff plan, for instance, and some say that's the upside. The question really is, should India be benefiting from that? I mean, given expectations of tariffs on China, for instance, would you be pulling money out of China now going back to India?
Well, India is not a manufacturing powerhouse, so it is not in the lens of what Trump is doing, or indeed anybody else thinking about tariffs. India is trying to go up the value chain in manufacturing, but it's a long way from there. People have already been taking out money from China and putting it in India and elsewhere.
We've seen it vice versa.
I would say there's the short-term flows, and India's benefited from that. You've seen how well the market's done. But I think more importantly is the strategic allocations. And India's benefited from the lack of correlation with the rest of the world economy, certainly China and also the US. And investors are willing to pay a premium for the long-term structural growth, for the secular drivers, the innovation, the scale, the talent, but also the lack of correlation. So that long-term trend, I don't think goes away.
Are investors really willing to pay that premium? We've seen, hedge funds pulling money out. We're talking about billions of dollars. And this is actually a market that's being supported by retail investors. If you take a look at the earnings recently, they've disappointed, and we've seen massive earnings downgrades at a significant scale.
Yeah, I think when you've had a market like India do as well as it has done over the last year, you're always going to see some profit taking. There are parts of the economy that are slowing down from very heady growth rates, but again, when you look at allocations to India relative to the rest of the world, they are low, and India finally is becoming an economy of size. It's top 5 economy in the world, very lowly reflected in people's portfolios. So I think the long-term allocations will go higher.
What are you hearing from your clients? Where do they want exposure, and what's the biggest risk for them?
Yeah, I think everyone is concerned about what a Trump presidency means for markets, what it means for tariffs, what it means for headlines. And I think headline risk into next year will continue to be difficult. So I think that's the main concern, bond yields in particular, and where interest rates, long-term interest rates go. Having said that, I do believe there's still an optimism that when you look at the budgets in the US, the fiscal situation in the US, there is scope for that to improve. When you look at the deregulation that a Trump presidency also potentially promises, it will be a very pro-growth business environment. So you've got this double-edged sword where the long-term story and the reform is a very promising one, but the short-term risk is potentially high. So people are not taking money out of the markets. I think they've learned that lesson from the last few years, but it's a question of how you protect yourself and how you broaden out your portfolio. And I think to your question earlier about where else benefits, I think there are pockets in Europe that will benefit from what's happening. I think the UK is one where it's a market that's really been left behind. Global businesses that, again, is a country that's not a manufacturing powerhouse anymore, not in the center of the lens in terms of tariffs, very attractive valuations for some interesting businesses. So I think as you see broadening out of the market, the UK benefits. Another market we're looking at closely is Germany, where you are likely going to see some political change over the next few months. There's a confidence vote next month, and there's an election in the new year, which is probably going to see policies pivot away from the direction they've been in for the last few years, which I think will be good for business. So those are a couple of the markets where I think you can find hiding places whilst we see what a Trump presidency brings about.
We know that investors have been looking at Trump's team and his nominations very closely. Besant, for instance, is one of them, and you've met the man.
I think the proposed appointment for Treasury Secretary is a very solid candidate with strong credentials, very level-headed, understands trade flows, understands economics and trade balances in a way that perhaps not everyone in the cabinet will. So I think that's a very solid proposal. The question is, what is the bigger plan that Trump has? Whether it's really about rebalancing trade or is it about weakening your biggest strategic geopolitical rival? And I think if it's the latter, then we're going to see these policies continue to grate at China and the markets for a while.
The policies indicated so far suggest that the strong dollar will persist, and we've seen how it's playing out in Asia in particular. We talk about the won, the worst performing currency in Asia this year. We've seen the likes of the Indonesian rupiah, Malaysian ringgit getting hammered as well. I mean, how are you looking at how this might impact, central banks in this part of the world, and how that would impact growth and eventually the attractiveness of the markets in Asia?
I think central banks are going to give themselves some room for maneuver as we wait and see what Trump's plans are for tariffs. They'll need some room to make sure that they can absorb any tariffs or the ripple effects of tariffs, so that they don't have as rough a trade position as they would otherwise. Korea is a case in point. We probably will see that with other central banks as well. So I think you're going to see softer currencies across the region. China is another one. Obviously, it's the key one where we expect them to slowly depreciate their currency.
So do you see devaluation of the
I don't think
yuan?
you'll see I don't think you see devaluation per se, but you will see a managed depreciation of the currency to give themselves room to deal with any tariffs. And the Chinese think very long term. We're talking about what happens over the next year. I think the Chinese, from our conversations with policymakers there, are thinking about the 4 years that you refer to, and also beyond. And one interesting snippet from China in the last few days is they've actually increased the number of public holidays in China.
To encourage consumption?
Precisely, and may not seem significant, but when you look at it historically, that's actually driven consumption when they've done that before. You've seen the stimulus of the last couple of months, so there's a real focus on ensuring the domestic economy stays relatively resilient, because the external impact from the US is difficult to forecast.
What is still in the toolbox for the PBOC to help protect growth in China?
Well, I think the risk we saw in China for the best part of this year was going into an asset price deflationary spiral. I think they've reduced that risk significantly by signaling very clearly that they're tidying up local government debt, they're providing stimulus to real estate, and they're stimulating consumption. So I think that risk is no longer significant. The bigger question for China is how they rebuild business confidence domestically, leaving aside what's happening externally. Domestically, how do they rebuild confidence? Because post Xi Jinping's elevation, post common prosperity, that compact between the leadership and the business community has been damaged. That trust and confidence in that model is no longer what it used to be. And I think the bigger question for the Chinese leadership is how they assure their philosophical and ideological objectives, but ensure that the business community feels the confidence to build. And I think that is not policy driven in itself, but that will take time. And that, I think, is key for investors like us to relook at China as well.
All right, Manraj, been a pleasure. Thank you so much for being with us. Manraj Sekhon, CIO at Templeton Global Investments. Still ahead this hour, Australia is close to passing a new law banning children under 16 from signing on to major social media platforms. We'll discuss the implications with the former head of Facebook, ANZ+. Union Bank joins us for a look at India's economic outlook as the central bank grapples with a weakening rupee and slowing growth. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Australia is on the verge of passing some of the world's toughest social media controls, banning the use of platforms including Facebook and TikTok for children aged under 16. It's become a hot political topic ahead of next year's election, with the Labour government arguing children's physical and mental health are at risk.
The bill puts the onus on social media platforms, not parents or young people, to take reasonable steps to ensure fundamental protections are in place. This is about protecting young people, not punishing or isolating them, and letting parents know we're in their corner when it comes to supporting their children's health and well-being.
Well, the measure has already passed the House of Representatives with bipartisan support and is now being considered by the Senate. Polls suggest many Australians back the ban. Let's bring in Stephen Scheeler, the former head of Facebook for Australia and New Zealand and now CEO of Omniscient, a startup using AI to decode the human brain. He's live in our Sydney studio. Stephen, good to have you with us. We can totally appreciate where Australia is coming from and wants to protect the kids. But is this the way to go?
Yeah, look, some of us have been constructive critics of social media for some time. Some of us like myself who helped build Facebook. But I don't know that this is the right approach. I think this is being rushed through very quickly. I think there's more experimentation, more trials and tests that should be done to really understand, where should the age limit be set? How do you confirm somebody's age online? What are the downsides and upsides of this? I think there are definitely harms of social media to teens, but there's a lot of good things that social media does for teens as well. And so I'm not the only one who believes this. The social media platforms are saying the same thing. But even advocacy groups are saying, hey, this might be a little too rushed, a little too draconian, and we want to get to the right balance and the right solution than what the government is doing right now.
Well, the thing is, Australia is not the first to want to do this. We had Korea considering back in, I think, even 2011, and we have France, implementing some form of regulation as well. But we know that about 50% of the kids manage to circumvent those regulations. I'm just wondering, in terms of how successful the move might be.
Yeah, that's really open to question now. As in most countries, social media is a core part of most teenagers' lives. It is, it's impossible to be a teen in most parts of the world without having social media a big part of what you do. Now, controlling that access from a parental point of view or a government point of view is not as easy as it sounds. There's no question that parents in Australia and other countries, they struggle with knowing what their kids are doing online. Not just on social media, but other parts of the internet. But also, what are the controls open to them? I think the platforms have been better in the past few years in many countries in bringing in more controls, changing some of the rules around who can get on social media, what access they have to different parts of how social media works. That's happened with Meta, with Instagram recently in many countries. But the argument here in Australia is that, well, these platforms haven't gone far enough. It's too harmful to people under 16, and therefore there should be an age limit set that bans it. Now, how do you enforce that can be very tricky. So one is, how do you verify people's identity and age when they get on the platform? Right now, Facebook does that in a pretty light-handed way using technology, but with this sort of new draconian laws, and there'll be severe penalties for the platforms if they don't enforce it, they're going to have to get compliance up to 100%, and that can be very hard to do on platforms of this scale. And then there's another question is, do you want the social media platforms holding your ID in the first place, which today they don't do. They don't hold your passport or your driver's license. But that can be very sensitive information. And as we know, protecting the information can be critical in terms of cybersecurity. So there's a lot of details that haven't been worked out. This doesn't affect teens. It affects every user of social media in Australia.
Well, obviously, social media platforms like Snapchat and so on and so forth have been pretty much up in arms. Some are even questioning, the likes of Elon Musk questioning whether it is a legal move or not. The thing is, for it to be successful, some say, you need that verification technology, which is not yet in place. Give us a sense of where this verification technology is right now.
Well, in some sense, it's quite advanced. So you have, we all know generative AI has taken off. Well, there are now tools using generative AI for image and facial recognition that can essentially identify how old you are based on your facial features. And these tools are pretty good. I mean, the accuracy rates can be pretty high in the 90%, but they're not perfect. So they can make a mistake. They can identify somebody who, hey, there's a photograph of somebody that they upload onto a platform. Let's guess how old they are. The difference between 16 months and 1 month old and 15 years and 11 months old and 16 and 1 month, is that going to be picked up by the AI? Not necessarily. There's lots of mistakes that can be made. And the rights of kids have to be considered here as well. I mean, if you have rights to access to something for a reasonable way of getting access to something, if it's too draconian, there's questions here in Australia, even from the constitutional basis, as to whether this may be an unconstitutional move because of kids' access to to information and to news can be restricted by this sort of forum or these kinds of moves. So there's a lot of detail that still needs to be worked out that the government here hasn't been forthcoming about. We really don't know how it will work in practice.
The thing is, the dangers are real. Here we're talking about cyberbullying, suicide. In fact, when you take a look at some data, it says that suicide is one of the leading causes of death for those between 10 and 24 years old. So the dangers are real. The question really is how best to address these concerns. I mean, if a ban is not the right strategy, what is? What should be, how should governments be looking at it? Some suggesting perhaps, what has been suggested in Australia is not really addressing the issue. What would?
Exactly. So in simple terms, I think you can separate this into two ways of addressing it. One is, social media platforms have a product that the government deems is not safe for kids, and therefore let's ban kids from using it. That's one approach. But there is another approach which says, well, could we put the onus on social media companies, a duty of care, to make their products safe and to make the controls much easier to use for parents and for users, to make them safe, make these products and these platforms safe for themselves. I think many would argue that it's better to go down the path of the duty of care and making products safe in the first place, rather than saying, well, these products are unsafe, we'll just ban the usage. We have seen from alcohol to cigarettes to anything else, if teens and kids want to get access to it, even if the government and parents declare this is bad for you, it's literally illegal to get access to it, kids still find a way. And so do we want that to wind up the same situation with social media, or even worse, the kids wind up in the darker corners of social media that may not be as regulated as these major platforms are. So I think that duty of care approach, I think, is a much more sensible way of thinking about this than simply going for these draconian age level bans.
How well do you think the government can monitor this regulation? Because a lot is at stake for social media platforms. I mean, the likes of TikTok, Snapchat, Facebook, they run the risk of getting fined 50 million Aussie dollars.
Yeah, they do. How well the government can monitor, again, is open to question. We don't know the monitoring regime that the government's proposing to put in place yet. That hasn't been articulated. When you look at the fine that you mentioned, look, $50 million is a lot of money to most of us. But for Facebook, Meta, for example, just to call them out in this, Meta earns that in 2 hours. And the average Australian worker will earn about $100 in those 2 hours. So it's like a parking ticket for Facebook and for Meta. It's not as big as it sounds. Now, if there's repeated fines and these can be extended, and certainly there's ways that this legislation could lead to bigger fines, yes, maybe. But these are largely wrist slaps financially. But I think the bigger issue is these social media platforms, not just Meta, but the others, they don't want to have to deal with a patchwork of regulatory, overhang in different markets. I think it's fair enough that they say, hey, let's just create sensible rules that we can apply everywhere, rather than us having to have different rules in different markets, and some of them really unworkable. And I do think this is largely unworkable because their ability to maintain 100% compliance with this sort of age gating, I think, given current technology, is virtually impossible. And I think that is even that is too much of an ask of the social media platforms like Meta.
I'm just going to put it out there, right, Stephen? When it comes to social platforms, they want the kids to be hooked on them all the time. It pays for them to have kids hooked and addicted. To what extent are these platforms taking care, of these kids? Are they considering the welfare of these kids? To what extent are they doing that?
Look, from my experience inside of Meta, Facebook back then, and this was a few years ago now, and things have moved on. But I think there was a genuine concern about the well-being of the users of the platform. I think that was genuinely shared by Mark Zuckerberg and the leaders of that platform. And I think it is probably generally shared by the leaders of other social media platforms as well. However, these are profit-seeking companies that are there to make money, which is perfectly legal, and we all make money for selling different products and services. And so they'd have a natural conflict, and their conflict is they make more money by having people, as you say, being more on the platform, more addicted or more engaged in their platform, spending more time. And so they have a natural conflict between their shareholders and their need to drive revenue and drive profit, and their sort of duty of care. And that's where I do think governments need to step in and have to make that duty of care a legal requirement that is much more regulated and monitored, and still let those platforms make money and do what they want, but bring in that duty of care. I think rather than trying to ban and keep these products away from kids, that simply is not going to work, I think, in the real world. We need to think differently about how we approach this problem.
I guess the question also lies in the conversations happening between the government and social platforms. I mean, if you take a look at the technology space, it is fast evolving. It is hard to actually have a regulation that's static. I mean, you have to consider developments in the technology space. What kind of conversations would make sense? And what is the relationship like right now?
Yeah, I mean, I characterize the relationship between the government and the platforms as probably semi-collaborative, but probably a little bit tense. I think there's no question the platforms at different times have tried to pull their weight with the government here in Australia. I mean, Australia is a small player in the global scheme of things for these platforms. These platforms are not, none of them are domiciled in Australia. No, they're domiciled in other countries. And they are, operating from overseas here in Australia. They've got a presence here, but they're not a domestic operating business. And so I think you see that muscle flexing that goes on. So there is a tension between the two of them, both the big players and the smaller players, I think, and the Australian government. But government has a lot of power as well. In Australia, the government has power to do a lot of things, and one is to restrict how social media and other media platforms operate. And so what we're seeing here is the flexing of muscles on both sides. We've seen these two parties stare themselves down with the media bargaining code in the past between Google and Meta and the Australian government. Now we're seeing it play out here. I think Twitter is now, kind of playing a side role in terms of particularly Elon Musk's voice. So it's going to be fascinating to see how it plays out. This is a major global power play that's evolving here in Australia. Small as this country is, this sets a precedent for much of the rest of the world.
Yeah, you got to wonder how the rest of the world is looking at it. I mean, the concerns are legitimate. Do you see other countries? Which other countries might consider the same move?
Well, I think commonly, you mentioned a couple at the outset, South Korea, for example. But commonly, it's many of the English-speaking countries, follow each other because they're very similar in terms of how people use social media. The legal system's similar. So there's no question that Canada, for example, the United Kingdom, the United States, are all looking at Australia in this instance as perhaps a precedent for how to think about things, particularly some of the states in the U.S., which have already been stepping in on a state-by-state basis to try to impose different regulations on social media platforms. We've seen that. And so there's definitely a real interest in what's happening in this country, across the world, but particularly in those English-speaking countries that really do follow each other very quickly when they think about how they regulate these sorts of issues.
What are the prospects for a global coordinated regulation so that it's pretty clear how, platforms can function globally rather than adapting to each market? Yeah,
I mean, we're entering this era, we've been entering this era over the past decades where the world used to be divided into individual countries, and within those countries, pretty much, companies operated within those countries with a few multinationals that could kind of game the system and kind of were almost had government power unto themselves. But we're now entering a new era of that with the internet, with social media, with big tech companies, with AI rising, where you really have companies that have global influence. But they're not, they're centered in only one or two countries. In this case, most of these big platforms are U.S.-based. A couple are based in other countries. But, as we've seen, the U.S. isn't necessarily on the leading edge of regulation, at least on a national level, about, how they think about consumer rights or kids' rights, or how do you regulate these platforms. So it's been led to folks like the EU and countries like Australia, Canada, others to step in to try to come up with their own regulation, or individual states in the U.S. It is a patchwork. It is a nightmare for the platforms and the companies themselves. I think they have a reasonable, request to say, hey, why couldn't we have one standard way to regulate all of this throughout the world? But good luck. I think that's going to be a tough ask, given the way world politics works. It's hard to get any two countries to agree on anything, let alone the whole globe, on how we're going to regulate anything, let alone social media.
Stephen, before we let you go, as we look at the advent of social media platforms, I mean, what's the biggest worry for you when you take a look at the trends developing right now?
Yeah, I guess I worry, if I were to worry, it was about two things. One is, the gaming of the system, I suppose, by the social media platforms, because they can play different countries off against each other. The fact, what you mentioned before, there's no standard way that we're regulating. It's a patchwork, and every country's kind of on its own, right? Australia's having to stare down the social media players all alone. Canada has to do it by itself. We don't have a kind of a concerted effort globally to do this, and I think there's a way for those platforms probably to play that to their advantage. So I think that's one concern. I think the other concern is just the rise of AI. What we haven't talked about in this conversation is actually AI, but what we're seeing here is the effects of algorithmic social media on things like the mental health of individual teens, and indeed on kind of the information ecosystems of individual countries, particularly democracies. And that's been driven by the rise of AI. And there's lots of great things that AI is doing. I build AI in my own company. But we have to keep in mind the downsides, and we're now starting to deal with them even here with social media. And so there's many more challenges that AI is going to bring to us as societies and as individuals, and I am concerned the world is not caught up to that enough, and we're going to see bad sides before we get on top of them.
Right. Stephen, great insight. Stephen Scheeler, CEO of Omniscient AI and former CEO of Facebook ANZ. Coming up, a closer look at India's economic outlook ahead of the RBI rate decision next week. Union Bank's Kanika, Pasricha will be joining us next. Keep it here with us. This is Bloomberg. India's third quarter GDP report tomorrow may show growth slumping further on fiscal, monetary and regulatory constraints. But Bloomberg Economics thinks this is unlikely to prompt the central bank to cut rates next month. Our next guest believes India's growth probably slowed to its lowest in 6 quarters. Let's bring in Kanika, Pasricha, Chief Economic Advisor at Union Bank of India. Good to have you with us. Why are you expecting such a dour number?
So I would say, Haslinda, first and foremost, let's also take into account the fact that there's a base effect to this number as well. Same period last year was a weak monsoon year. Globally, it was an El Nino year. And because of that, the construction activity picked up significantly. Mining was very strong last year. So the base is of 8.1% growth, same period last year. So which is why this year in the September quarter, partly due to the base, we are penciling in a 6.5% growth number. Yes, lowest in almost 6 quarters. That's one. Second, yes, I would confess that due to excess rains and just ahead of the festive season, sometimes demand does get hurt, and it's primarily urban consumption that may have got hurt during the period, even though government spending picked up after the election quarter, which was the first one, April to June. So overall, yes, lower growth in this quarter. But post-September, October has seen an improvement in high-frequency lead indicators. The second half of the financial year ending March is still looking relatively better compared to the first half.
When it comes to the projections through March, we're seeing a divergence. We have the government saying 6.5%, RBI saying 7.2%. I mean, what do you make of that discrepancy?
So actually, if you note the way the government talks about the projection, they give a range of 6.5% to 7%. That's what the CEA says from the government perspective. You see, RBI is actually at 7.2% for the year. For this quarter, they were at 7%. But in their bulletin, they revised it, they pegged it lower as per their nowcast model to 6.8. So maybe, in the monetary policy meeting next week, that's why we are expecting that there is a chance of RBI slightly lowering their growth projection from 7.2% for the entire financial year to maybe closer to 7% with mild downside risk. But I'll just confess that for the second half of the year, as of now, the initial signs coming from high-frequency indicators is in line with RBI's projection of a pickup in growth in the second half. It's just that, they are very optimistic at around 7.4, 7.5% growth in the second half. That may or may not pan out. That needs to be looked at. Yes, we are pegging it lower at close to 6.97% in the second half. So which is where
we know that
we would. Yes.
We know that the RBI is set with a decision next week. I'm just wondering what the chances are that we might just see a cut. We saw that surprise cut by the BOK. There's a lot of concern about Trump's tariffs and the impact of growth in this part of the world.
So 2 points, Haslinda. See, first and foremost, RBI is an inflation targeting central bank. The latest inflation, and their range is 4 plus minus 2%. The latest reading came in at 6.2%, above the upper end of the target range for inflation as well. So while the RBI was projecting a hump in inflation in October, but it seems that the number is higher than even their expectations. Yes, inflation likely to ease in the coming quarters as the food price volatility, especially led by vegetables, eases out. But we think the RBI is likely to be in a wait and watch mode from that perspective. See, even if you look at 6.5% for this quarter growth, or closer to 6.97% for the second half, we are still one of the fastest growing economies in the world. I would say from Trump tariff impact, the channel of impact for us has been primarily via FX, and that needs close watch, which also warrants rate cuts later rather than sooner from India MPC perspective.
Kanika, we know that the term of Governor Das ends in early December. We've yet to have any clarity on whether there's been an extension or a replacement. How concerning is that for the markets?
I would say, first and foremost, the recent media source talking about possibility of an extension is definitely a positive because of the way Governor Das has beautifully managed markets and macros, especially during crisis periods, including the crisis period of COVID over the last 6 years. So if an extension is granted, of course, a positive. But in the framework that we are in right now, it seems that the RBI has defined the contours of monetary policy very well. It's an MPC-led decision. So even if a new governor joins in, the framework is set very well. So would see policy continuity at the current juncture.
We shall wait and see. Kanika, thank you. Kanika Pasricha of Union Bank of India. Now, before we go, here's a look at tomorrow's show. We have an exclusive interview with Air India's CEO, Campbell Wilson. We'll discuss the carrier's outlook after completing its merger with Vistara earlier this month. Plus, we wrap up a busy week for markets with Barings Global, as multiple central banks in this region cut rates ahead of next month's Fed decision. That is it for Insight. Horizons Middle East and Africa is next. This is Bloomberg.